Hey friends, we need to talk for about 10 minutes. It's about China, specifically on Alibaba and Chinese equities. There's one big obstacle that is stopping Alibaba and the Chinese internet sector from an epic rally. I recently talked about this on Twitter as well. Lots to discuss today. We're going to talk about when we can expect the fundamentals to improve, and I want to thank our sponsor Morning Brew for sponsoring today's video. More on this great newsletter in a moment. If we're meeting for the first time, I'm Larry. I spend about 50% of my channel covering China macro and Chinese equity strategy, and the other 50% on US markets. If you're interested in understanding where Chinese stocks go from here, you can rely on my research to help you. Heartfelt thank you again to my public community and Patreon community for supporting my research and insights. Make sure to join my email list below for important high-quality periodic updates. With that said, let's get into the video. In my opinion, there is one major stumbling block that is stopping Chinese equities from continuing their epic rally. And no, it's not Charlie Munger dumping half his Alibaba stake, and no, it's not delisting fears, and no, it's not even the geopolitical fears from the Russia-Ukraine crisis. Don't get me wrong, those are all important topics, and I'll talk about them in future videos, so stay tuned for that. The big elephant in the room that is restricting fundamental growth for Alibaba and its peer companies is China's zero COVID policy and the latest COVID outbreak that we're seeing in China. Now, I know a lot of retail investors continue to think what moves Chinese stocks is delisting fears, SEC regulation, or Charlie Munger, but all of that is just wrong. And I think that it's a downright narrative trap to believe these things actually impact Chinese stock prices long term. It all comes down to the health of the Chinese economy, which is heavily influenced by policymakers, and then how Alibaba, Tencent, Baidu, and JD are doing. The reason that Alibaba is down right now and under pressure is because the Chinese economy is experiencing a slowdown, and the regulation that we have seen in the past 12 months, the zero COVID policy, is making the situation more severe for consumer leading companies like Alibaba. And when China is seeing economic softness and consumers buy fewer things, there's less retail shopping, and therefore we see Alibaba and other Chinese companies experiencing fundamental slowdowns. I'm going to talk about how the zero COVID policy is the defining catalyst before a durable rally. But just before we do, I want to talk about our sponsor today, Morning Brew. Morning Brew, the daily email newsletter that covers news from Wall Street to Silicon Valley, is now on YouTube. I'm on their email list, and every day I receive approachable, thoughtful, and humorous content. They talk about technology, trends, and companies that you care about, but they do it in a way that isn't technical or boring. They have a series called Point of Return as a YouTube playlist all about unique investments. Each episode features regular folks, not financial advisors, talking about the best investments that they've ever made. Here are some of the videos in the Point of Return playlist to check out. The videos talk about entrepreneurship, millennial saving habits, and interesting ways to make money. Click the link below to subscribe to their channel for new episodes and let them know in their videos that I sent you there. Also, don't forget to sign up for their email list on their website. And thanks again to our friends at Morning Brew. Now, okay, back to zero COVID. As we all know, China's response to COVID has been a lot more strict than the way the US has managed the virus. The recent COVID outbreak has caused Shanghai, which is responsible for roughly 3.7% of China's GDP, to go into lockdown. Now let's do the math and understand from a big picture standpoint what is the impact of Shanghai and other cities' lockdown on Alibaba, which is the main proxy for Chinese e-commerce consumption. Here are the facts that you need to know. Shanghai is responsible for roughly 4% of all retail sales in China. With Shanghai locked down and consumption restricted, we can safely assume that Alibaba's core gross merchandise value, their GMV, reflects slower growth in the upcoming quarter as it accounts for March and April. We can also safely assume that Alibaba's GMV will fall roughly several percentage points as sell-side analysts are adjusting that into their models. And that's why we saw the retracement from Alibaba be more significant than internet-driven companies like Tencent when COVID hit Shanghai. Now, Alibaba's other business segments and local consumer services will face disruption from lockdowns on offline channels. and their cloud growth is being impacted by weaker demand in the internet sector as the consumer and market activity slows down because of COVID. So sell-side analysts who I follow are cutting the entire fiscal year revenue estimates by 7 to 10%. And that is why we've seen Alibaba retrace the move from 120 back to 100. From the COVID event in March and April, I think that these estimates are reasonable, but they do not account for upside from a recovery in Chinese consumption if there is monetary stimulus. So my conclusion here is that while the sell side is correct to lower their Alibaba revenue forecast by 7 to 10% due to the COVID situation, I believe that there's a lot of room to go right over the next 6 to 9 months if we see monetary policy loosening. Now, if you like what you see here, hit that like button, share this with any investor you know in Chinese tech. It's an important message. The reason I feel relatively upbeat here is that China's economic data points clearly call for stimulus. Here's what I mean. China's CPI rose 1.5% year on year in March. Inflation isn't that high in China, so easy money policies aren't as likely to spur the same inflation fears that we see here in the US. Now, last week, a State Council executive meeting noted that domestic and external environments are faced with growing complexities and uncertainties, and this could make a greater use of monetary policy tools to more effectively support growth of the real economy. In addition, the China Services PMI dropped to 42 in March from 50.2 in February, and any reading below 50 indicates contraction. The China Manufacturing PMI dropped as well to 48.1. Now, the Global Times, which is the editorial newspaper of China, has been pushing for more government support to boost retail sales and domestic consumption. So in short, while I respect the concern that people have about Charlie Munger selling Alibaba or the delisting fears, the real focus should be on the way COVID cases are being handled in China. I personally don't think the zero COVID policy is going away until President Xi gets reelected this fall at the 20th National Congress Party event. But I also don't believe that the zero COVID policy needs to be completely removed for a consumption recovery. If it does get removed, then consumption trends will accelerate and all of that will flow back into Alibaba and JD's business models. But even if it doesn't, as long as COVID cases slow down and China manages its peak waves well, COVID is eventually a situation that can be overcome. Now, that's what happened here in the US. That's what happened in Europe. COVID is an overcomable event. It's also very important to realize that many of the COVID cases in China are asymptomatic, meaning that most people aren't even experiencing symptoms or feeling sick. And also, the number of cases in China are being blown out of proportion. Their case numbers are frivolous compared to the numbers that we just see in my city in Boston alone when we were seeing a huge wave of COVID cases earlier this year. And what happened every single time the US market sold off on COVID? It recovered every single time. Will this impact Alibaba's next quarter earnings? Yes. But if you're in this name for the long term, you shouldn't care about next quarter. You should care about the big picture. And if there is monetary easing, the big picture is going to get a lot better. Now, I see monetary easing happening in the second half of this year. President Xi is strongly incentivized to stabilize the economy, the same way Jerome Powell wants to fight inflation. And as a general guideline, I believe that the more damage that COVID is doing to the Chinese economy, the stronger the stimulus will be. And the deeper the drawdown here, the stronger the bounce. Few people will be able to take advantage of this, but I intend to use my research to ensure that you, my viewers, and my Patreon members are the people with the last laugh. And trust me, you want me to be right because China drives about 1/3 of global growth. So if China pursues stimulus, you and me, our friends in the US, Canada, Europe, we will all benefit. Stronger global growth will also partially offset any domestic weakness that we see in the US as we unfortunately head into tightening. So the road ahead in the US is going to be bumpy because what do? We don't fight the Fed. And one important fact for you, there is a 90% correlation between China's GDP and S&P 500 earnings per share. So strength over there means strength over here. So hit that like button so that more people will see my research, share it with friends and family. I've got some deeper insights and analysis in my Patreon if you want to be a part of my global investment community off YouTube and be able to chat with me one-on-one. With that said, I hope you enjoyed today's video update, and I will see you in my next video.